following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome to Volatility Views and our inaugural program here for 2013, a new year and a new slate of Volatility Views programs for you, the listener, to enjoy. We have a lot of great topics on the horizon, a lot of great guests, all coming down the pike for you, the listener. I'm really excited about all the fun stuff we have in store for the Vol Views audience here in 2013. My name, of course, is Mark Longo from the OptionsInsider.com as well as the Options Insider Radio Network. And joining me on the Volatility Views panel today, we have none other than the man, the myth, the legend, good old Don Schlesinger himself from the Volatility Exchange. Don, welcome back to the show and Happy New Year to you.
Thank you, Mark. The same, and Happy New Year to all of our listeners. Obviously, couldn't be doing this show without your support. We hope you had a great 2012 and looking forward to an even better 2013.
I know we had a great 2012 on Vol Views, and I hope all of our listeners did the same. And I know you and I are both pretty excited about what we have in store for the listeners in 2013. And it wouldn't be a Vol Review without our complete team, so we are joined right now by one Mark Sebastian from OptionPit.com. Mr. Seabass, welcome back to the program and Happy New Year to you.
Woot, woot! I'm here. Good to see everybody.
Bringing that enthusiasm, as usual.
Yeah.
Hats and horns. Happy New Year, Mark.
It's good to be back.
Now it's time to dive right into our volatility review.
It's time for the Volatility Review.
All right, and it's time for our first Vol Review of 2013, and what a week it has been so far. Of course, we've been talking on recent shows about the impending fiscal cliff and how that had turned the volatility landscape very much into this binomial landscape, a will they, won't they type of event where things like fundamental analysis and realized versus implied and all the other things we extol on the show on a regular basis were pretty much thrown out the window, and it all came down to what the politicians worked out there in the wee hours in Washington, D.C., and of course they did finally put a deal together, as a lot of people suspected. Not ideal, but hey, that's they got something done, and that was better than nothing, of course. The market responded in kind with massive rallies across the board, and of course, aggressive sell-offs in the VIX cash. As we are recording this in the middle of the day here on Friday, the VIX cash hovering south of the 14 handle at 1385 right now, down another 5% on the day today, and just a aggressive sell-off across the board for the past week in VIX. So let's start there. Mr. Sebastian, obviously a lot of stuff to catch your eye over the past week in VIX. Let's start with this just pronounced sell-off. What really struck you about that?
What's hilarious is the VIX has hit, in the last 10 days, the VIX hit its 52-week high and 52-week low, including today. Crazy, right?
Crazy stuff.
There's just no question that this is really unprecedented movement, and I read something this morning that was of interest. We actually haven't been on the air for 2 weeks, and so we've had all this dramatic movement in the past week, but we also signed off 2 weeks ago, and at that particular time, we were all kind of screaming about VIX in 2022 range. And Mark, you were very adamant about the impending collapse of implied volatility. And I think that I was shouting just as loud about these single-digit realized volatilities, with the S&P at about 9 3/4 and NASDAQ at south of 13 at about 1290. And of course, we were talking about that huge 11-point spread from 20 to 9 or 22 to 10, 12 points on S&P. And we were all clamoring for the collapse of that spread. Well, I'm not sure any of us thought that it would actually go negative, which is quite extraordinary. But as we sit here today, NASDAQ has increased from 12.9 to 18.2 on 21-day realized volatility, historical or trailing volatility, and the S&P from that single-digit handle of 9.73 currently at 1403 trailing 21-day. And you just heard Mark say that VIX is around 1382 right now. So not only has the spread collapsed, but it's actually gone negative. And this movement of VIX included 2 consecutive days of a 15% drop in the VIX index. And what I read this morning is that is the first time that that has happened since the crash of 87. And of course, in those days, for the crash of 87, we had realized volatility in the 80s and 90s and implieds over 100 in triple digits. So it wasn't unthinkable by any imagination that when things calm down a little bit, you could have a 15% drop because you were going from 100 to 85, and then another 15% drop, into the 70s for implied. That was almost normal or to be expected. But to have those kind of consecutive day drops when you're starting at 22, and then all of a sudden you're down at 17, and now today you're at 13 and change, is actually quite extraordinary. Only a second time it's happened in 25 years.
All right, Don. Yes, of course, a lot of action in the good old VIX. Also some action on the NASDAQ front. Why don't you run down for our listeners what really caught your eye in the vol apocalypse over on the NASDAQ side?
Well, I'd like to point out one other thing in addition to what I just said about the increases in realized volatility. And this is true not only for NASDAQ, but for the S&P as well. And it's something else that I had commented on several weeks ago, and that was the volatility of volatility itself. And what we mean by that is simply that volatility as a commodity or as an asset class, if you want to consider it as such, displays its own volatility and its own movement. And I had talked about some historically low levels in the 70s and in the 50s for vol of vol, or the volatility of volatility. And since that too is mean reverting like volatility itself, I commented that I would have expected there to be a great increase in that, which meant that there was likely to be movement without predicting whether it would be up or down. Of course, we were predicting it to the upside for realized volatility. In volatility itself, well, as we sit here today, the implied or the volatility of volatility for NASDAQ is now at 133, up from 95 when we last commented on this, and the vol of vol for S&P is 152, up from those double digits of 90 or 100 or so that we commented on the last time. So interestingly enough, for the entire atmosphere of what we were predicting, not only that we thought realized volatility would increase, but also that there would be an increase in this actual vol of a vol. You might have considered a strategy where you were trying to capture realized volatility by perhaps owning an at-the-money straddle, but at the same time, you thought that number was going to go up. So maybe you weighted it towards the upside. You weren't delta neutral. In my day, I don't know if they talk about this anymore. They used to talk about strips and straps. And a strap is a straddle with an extra call, and a strip is a straddle with an extra put. So in this case, you might have made a bet not only on volatility in general, but in an increase, so that basically you'd weighted a little bit more to the long side.
I hear people bandying about strip a lot these days, but not in that use case, mostly in buying a strip of downside puts or something like that. But yes, we don't hear those terms much anymore, but the underlying strategy is still used very much, overweighting, underweighting, and because even people who are delta neutral sometimes or close to delta neutral still have an opinion one way or the other, and they like to overweight or underweight to express that opinion. And that's exactly what you're talking about here, Don. That certainly would have been an interesting trade going forward, I think, for this position. I think perhaps in the mailbag we shall discuss another interesting trade that I know Mr. Sebastian has been going on about at length for some time here on the show, about how the potential way you too, the listener, could have potentially position yourself ahead of the fiscal cliff implosion. In fact, that might be a good time to transition right now. We'll close out the old volatility review and dive right into our listener mailbag.
Listener mail. Listeners write in. Mailbox.
All right, and welcome to our inaugural mailbag segment here for 2013 in Volatility Views. And as we like to do here on the program every now and again, we like to give you, the listener, a chance to join us here on the panel and sound off with your own questions and comments about volatility and volatility trading. We have an interesting mailbag this week. A lot of people writing in with some end-of-the-year comments and questions, including just some general love for vol views here, Don. Like a tweet here from Mr. Southbay Trader, who just wrote in and say, I especially like volatility views. You know what? This man has taste, Don. What can you say?
There you go.
So thank you, Southbay, and we like you too here on Volatility Views. Gotta love Twitter. It just makes for the very pithy expressions. We also have someone coming in. I think it was some of these Twitter handles are impossible to read here, Don. I think this is Billmoo, and he just named us as the top financial podcast of 2012. Actually, he meant the network as a whole as well, but he also likes Vol Views. So more love pouring in from Vol Views here from our listeners, Don, towards the end.
Do we have podcast Emmys?
Yeah, we need something. I know there are some, I think, new media awards and a few other scattered things, the Webbies and whatnot. We tend not to go out for those sort of things, but yeah, it's nice to get the love from our listeners. That's where it matters, right, Don? From you, the listeners. Let me see here. What else do we have in the mailbag? Oh, a couple questions. First off, I think, Don, this is actually an interesting one that I think just is right up your alley. So it's a perfect question. This is an email from Alan Jacobs coming out of Danbury, Connecticut. Not that far from my old hometown. And he says, can you guys talk about dispersion trading? I've heard that term quite a bit recently. I think it has to do with volatility trading, but I'm not sure how or why. But I think I've turned to the right people for help. Thanks for your show, Mark. It's a big help to people like me who aspire to one day be volatility pros like you guys. Well, Alan, we're glad we could help. We hope your quest to become a volatility professional is a successful one. And you're right, your question is very timely because dispersion trading is very much a hot topic. It's kind of like iron condors we talked about in a few shows back. That's another very hot topic right now. Dispersion trading is another one. I can't tell you how many guys I know who are former market makers, might still be in the business, who've told me in the last couple of years, I'm getting into dispersion trading. It's the thing. It's a very simple technique. It sounds, I think, a little bit more advanced or elaborate than it actually is. It usually just compares the implied vol of an index, like usually the S&P 500, but could be any basket or index that you've created, against the individual component stocks and underlyings that you're trading. So what you typically might see is someone coming out and, let's say, shorting at the money straddles in the SPX or the SPY or maybe the Russell, and then buying long, could be long straddles, long strangles, long individual vol positions in some of the underlying names and looking to make money profit on the differential between the two. There's some disparity there between the implied vol of the underlying components and the basket as a whole. And so you're just trying to trade the basket against the individual components. It's a very time-honored technique. A lot of people, I think, like your question implies, a lot of people think that this is some sort of a modern invention, that this is only in the last couple of years that dispersion trading has actually come around. That term probably has been popularized in the past couple of years, but this technique has been around forever. In fact, way back in the Stone Age, Don, when you guys were riding dinosaurs and selling puts from the back of the Brontosaurus, I believe this was one of your favorite strategies as well. Am I right?
Well, that's kind of funny because, yes, it was, and it was something that we did do a long time ago when we kept our positions on the inside of the cave walls and, tracked our volatility.
Now,
but,
did you actually call it dispersion trading? You probably didn't.
Yeah, as a matter of fact, we really did.
Really?
Okay. And so the term itself is not new either.
We're ahead of the curve then, sir.
And so I can remember doing this, I'm pretty sure, in the late 80s and surely throughout the 90s. And we did it actually with an index that was a great correlation and close to tracking the Dow Jones Industrial Average. And it was called the Major Market Index that came out of the American Stock Exchange. And the symbol was XMI. Everybody called it XMI. And it was 20 names instead of 30 that were in the Dow, because at the time, Dow Jones Irwin didn't license its products for any kind of trading vehicle. Back in those days, you really couldn't trade the Dow the way you can now with futures and diamonds and various products that actually trade the index itself.
You had to do it the old-fashioned way and build it yourself.
So at the time, we actually used this major market index, which was 20 names and had something like a 97% correlation to the Dow Jones Industrial Average. It had all the household names in it: IBM, GE, GM, Procter & Gamble, DuPont, etc. And it went exactly the way you described it, but I'll give a little more detail in terms of the expectation for correlation or lack thereof. When you have a basket of names, for example, these 20 or the 30 of the Dow, each one of the components obviously goes off in its own direction in terms of price movement and also in terms of its individual volatility that it displays. And of course, they all contribute to the index itself and to that basket, which we would then call the Dow Index, the S&P, the XMI, or many of the sector indices that we have today. And so the concept behind the trade, as you described it, Mark, is to take a look at the individual names and take a look at the index volatility as a whole and see if you can't identify some opportunities for increase or decrease in correlation among those names or dispersion. So let me give a very simple example of if you had a basket of only two stocks in it, A and B. The principle is that when those stocks disperse or go off in their own directions, you could have stock A going up 10% and displaying a great deal of volatility in the process. You could have stock B go down 10% and display just as much volatility in the process. So if you were long straddles in those two names, you would hope to make some decent money with those straddles, both from the fact that the price movement would be greater perhaps than expected, but that in the process, the individual volatilities would be increasing. Now, at the same time, those two names contribute to the price of the basket. Well, if one of them goes up 10% and one of them goes down 10%, and in this case, if they're equally weighted, the basket goes nowhere at all. And so basically, its price is unchanged. And if you're short that volatility or short that straddle, you obviously can make money on that end as well, as the individual index goes nowhere and the volatility decreases. So the concept here is, if you are expecting a decline in the correlation among the names. If you're expecting a great deal of individual volatility, but not correlation, this can become a very profitable trade as you own all those individual straddles on a whole bunch of names while you are short the index as a whole, and where you hope that because of this dispersion or the lack of correlation, the index won't move all that much at all, and its volatility will be stable or even declining. So the only other comments to make, because you always want to look at what can go wrong, or what are the challenges in this kind of a trade. What can go wrong, obviously, is just the opposite of dispersion or lack of correlation, and that is all the individual names move in the same direction. And that can happen not only on a day like we had just recently with the tremendous upside movement, where you'd be hard-pressed to find one name in the Dow, for example, that wasn't up on this historic 300-point move the other day. But of course, it can also work in the down direction, where you have some sort of a crash or some sort of a catastrophic event, and all of a sudden, every single name is moving in the same direction, and it's down. When that happens and correlation increases, unfortunately, you don't make as much on those individual moves as you get hurt by the fact that they all conspire to go in one direction and send the index either reeling tremendously with a huge increase in implied volatility, or even going in the other direction with a tremendous upside move, which may not do much for the implied volatility, but because of the price movement, actually hurts you if you're short a straddle as well. So that's the challenge to the trade. And then finally, of course, because you may be managing 20 or 30 different positions, trying to keep the straddles delta neutral to capture the volatility every day, that's a lot of trading. So a lot of commissions, commission intensive, as you use options in order to capture the individual dispersions from each one of the components of the index, and therefore a lot of positions to monitor, to keep track of, and those commissions can start to add up.
Yes, which is why we don't see this executed too often on the retail side. It's laborious, it's commission intensive, you have to be able to capture that vol pretty precisely. Difficult thing to do on a retail account where the margin isn't the same. You have to have a lot of capital at your exposure and a lot of under knowledge too. That gets back to some of our earliest episodes of this program with the issues with trading delta neutral and why it's difficult to do that on a retail side as well.
If you're serious about dispersion trading, you almost need to be self-clearing. That sized. Otherwise, your cost structure is going to be too difficult.
And one of these days we'll change all of that. We'll get not only our real vol futures out on the indices, but we'll somewhere down the line get them out on individual stock names as well. And you'll be able to grab a whole bunch of them and be long individual name volatility while you are short realized volatility of an index. I hope that day that comes sooner rather than later, but obviously it'll be a much purer way to do such a trade.
Don Schlesinger, the savior of the retail volatility trader. You too can do dispersion trading from home. So there you have it, Alan. Dispersion trading, been around for a while. I, of course, remember a lot of the big market-making firms when I was on the floor in the mid-'90s taking advantage of this technique as well. Timber Hill, other Susquehanna. This was a popular technique with some of the big firms who figured out early on that hedging baskets against individual names was a profitable strategy. Everyone used to like to stand next to the Timber Hill guys. Timber Hill, of course, being the market-making arm of Interactive Brokers, because every once in a while their screens would light up and they would just lift offers on a particular option or hit the bids on them. Sometimes it was an order coming through from IB, but other times it was just their guys upstairs running the basket saying, hey, we need to hedge this particular element of our dispersion trade, buy these, sell these. So it was great if you were an individual market maker standing near them because you had an extra source of paper at your disposal. So yes, this has been around for quite some time, including back on the cave walls when Don was slinging vol. Next up, we have a tweet from Mr. Leroy, and he writes, or he asks, I should say, why weren't people he says aggressively people, maybe we should flip that around. Why weren't people aggressively shorting vol pre-cliff deal like the debt deal? And this is an interesting question. We've talked about this obviously in the show in the past, and the answer, of course, is that they were. I mean, if you listened to our show recently, you heard people blasting away at implied vol against the realized vol to capture that differential many times. We've, of course, discussed on this show many times just how much that disparity has grown between implied and realized. Realized has done essentially nothing, and implied has been all over the board recently. So there still has been a lot of room, even with the major media outlets running down your throat that vol is cheap, there still has been a lot of room to short implied and buy realized and do fairly well. But I can see where this question is coming from, because if you remember back to the debt ceiling kerfuffle last year, going into that trade, all you heard all day long, everywhere, even in a lot of the mainstream outlets, which surprised me, was that everyone and their mother was shorting VIX. They were buying VIX downside puts, they were writing VIX calls, they were selling call spreads, etc., etc. They were shorting VIX futures. Everyone and their mother thought a deal was going to happen regardless of the outcome, and vol was going to come off aggressively. Of course, we saw what happened post that deal. The deal did happen, the vol came off momentarily, and then we had, of course, everything blew up. So a lot of people really got hurt in that. You really had to roll those downside positions for several months at the least to make them pay off. So it was a very painful trade for a lot of people. I think you saw that play out this time. A lot of people got burned doing that last time, and they were a little bit more hesitant. You didn't see a lot of the same paper, like people coming in and buying tons of downside puts and put spreads in VIX and writing upside calls. You saw some of that, but nowhere near to the substantial degree that we saw a little over a year ago. So I can see, I echo your question, Leroy. You're right. It wasn't the same level of paper flow one direction as we saw a year and a half ago or so, but it was still out there. It just was a little bit, I think, more nuanced. Mr. Sebastian, would you concur with that?
Yes, very much so. We were, there were a lot of different ways to skin that cat leading into this thing, but the truth of the matter is that if you traded the trade that worked the best was kind of the short time spread in this case, where you wanted a lot of gamma. You just wanted to be short Vega at the same time. That was the play that worked really, really well into this cliff deal. Andrew and I actually executed you'll like this one, Mark. Ahead of the deal, we went in and bought straddles in the Jan 4 weeklies. All right, so the ones that are expiring today. And then we bought puts in VIX and VXX against it. So what we wanted to do was kill all of our Vega exposure and take advantage of what the VIX rightly predicted, which was a 5+% move in the underlying S&P 500.
So you, just to clarify, you bought SPY weeklies and then you did the VIX straddles. Yeah, okay. Yeah.
Straddles, and then sold VIX and bought VXX puts.
Yeah, you've been extolling that long gamma short vol trade for a while, and it certainly seems to pay out. Yeah.
It works. I know Don, no, never owned gamma. Schlesinger probably would not have put on. He would have done it probably differently, but it was a good way to be able to sleep at night and take advantage of what was about to happen to the VIX futures.
Hey, I think it's a great trade. You were short Vega, as you said, and so basically, two parts to it. Nothing wrong with that.
Oh, thank you. All right.
There you go.
There you go.
A compliment from the man himself.
Wow. Now I feel special.
That's better than an Emmy or any other sort of award, an Oscar or whatever, any other sort of award you could possibly get.
That was my Oscar.
A pat on the back from Don Schlesinger. All right, next up we have...
We should just point out quickly to listeners something that's second nature to Mark, having done the trade, but when you do a calendar spread or a time spread, which means usually the same at the money or near the money options, but over different expirations, that has the characteristic that if you own the spread, if you own the longer dated ones and a short the nearer term ones, then you will actually profit from an increase in volatility, as the longer dated options are more sensitive to volatility movement than the shorter dated. But this was just the opposite. This was selling the calendar spread, being long the nearer dated, so that if you had big movement in price, you captured the gamma sensitivity. But all the while, if volatility was going to come off, you were going to profit more from being short those longer dated options than the nearer ones. So sounded like the ideal trade for the scenario, and in this case, it turned out to be right.
Yeah, Don, I got asked, why did the VIX implode so much? And, the one thing I would say is that it was pricing, 22% on the Friday before all these shenanigans. And so we moved over the next 2 days, a little over 5%, which equates to a daily realized volatility of 40%? Something like that, around 40. And so you get 2 days of around 40% volatility. How many days of sluggishly low volatility do we need to make it to justify a VIX of 22 with 2 days that are 40%? A lot, actually.
Absolutely.
And I think that's why we've seen the VIX come off so much.
Yeah, this was a historic movement. We'll talk, a little bit more about it, but this is really an incredible move.
As we always say, a strong knowledge of basic math will serve you well when doing your volatility trading. If you can calculate realized vol and a few other things, then you're ahead of the game. Next up, we have an email from someone who wanted us to withhold his name, so we shall do so. But he says, I run the vol book at a local shop. I found your show about Mr. Black Swan very illuminating, and you and quite a few others, it seems like, Mr. Anonymous, because, Don, I was looking at the numbers for the end of the year last year, and those Black Swan shows certainly lit a fire with people. We might have to revisit that topic at another time. People
Just
love
as
themselves.
I was going to make a New Year's resolution, never to mention the name
Never to
again.
do it again. I think it's the people love him or hate him. People want to, I think probably a lot of the latter in our audience, but it fires them up. It's like the old study they said of Rush Limbaugh. People who love him listen to about 10 minutes. People who hate him listen to an average of 25 minutes. So people who hate to leave, I think, swarmed to those shows en masse. But he goes on to write here, I've read all of Mr. Talib's books, or Talib, however you want to call him, and even met him several times. Like you, I assumed his trading style to be heavily long premium, and was surprised to hear the opposite. I would expect former market makers like the Marks, the Marks, I like that, and a former upstairs trader like Don to be aggressively short at the money premium, but not Mr. Talib. He appears to be preparing himself for his Black Swan events by backspreading and being net long units, so it isn't a complete cop-out. He's not just riding at the money straddles and heading for the hills. Like all of you and your recent guest, he's referring to Jared Woodard of Condor Options, he says, I too am left with a somewhat bitter taste in my mouth after learning this information. It doesn't fit with the overall message and marketing of his work. And I think that's the message we were trying to say too on the show. It just, all of us were kind of, I think, left scratching our heads and a little bit bewildered and perhaps befuddled at, the overall, I think one of the key words you use there is marketing. He's certainly been marketed a certain way, perhaps not to his fault, maybe somewhat to his fault, by his publisher and others as kind of this, almost this prophet of doom, as you will. And so that image certainly doesn't really jibe with, the trading style he seems to have adopted for himself. So yes, it does certainly a little bit of contradiction there, and I'm glad to see that you yourself, another professional in the ranks, feels the same way. All right, and then last up here we have an email from Theodore Grant coming out of good old Pittsburgh, PA. He writes, Mark, Volatility Views is my favorite show on your network. Well, thank you, sir. I wish there were more podcasts out there talking about volatility trading. You guys truly stand alone. My question has to do with tail risk, one of your favorite subjects, and it is indeed a common topic of conversation here on the show, Mr. Theodore. Theodore writes, you guys always talk about tail risk and how it's become dramatically overpriced in indices like the S&P 500 and even large cap stocks like Google. What about in commodity products like GLD, corn, oil, etc.? In those products, the tail risk is found on the upside. Do you see the same overpricing of premium in the upside calls in those products as we currently see in downside SPY and Google puts? Thank you, Theodore. And yes, we talked about this on a recent show about the inversion of the skew in the commodity products and how they tend to catch that bid to the upside. We talked about a little bit. Apple seems to exhibit some of that as well, not as aggressively as the commodities, but it certainly is unique in equity land on having a somewhat commodity-esque skew, particularly in the call wing. And yeah, we do. It depends really on the product and on the time. I think overall as an aggregate, and Mark, you can probably weigh in on this too. Overall as an aggregate, I don't think we see the same level of just preponderance of bidding up in the commodity side as we do on the S&P 500 side, partly because we haven't seen, I don't think, the same commodity doomsday prophets in the commodity realm as we have in the S&P 500 realm, like Mr. Taleb. He's one of the primary reasons that these downside puts are so bit out of control. Him and a few others have really expounded on this notion that we're not prepared for extreme event risk, so everyone and their mother, particularly on the retail side, have just piled into these puts and really bid them out of the control. I don't see the same level of participation across the board in all these commodity products. They're a much more specialized type use case for the most part. So you don't see mom and pop really piling into upside oil. Sometimes you do, but not as frequently. Of course, there are days that stand out. We talked about the day of rage last year in oil, and people were buying calls $100 out of the money willy-nilly. That certainly was an extreme moment of extreme tail risk being bid up out of control. But I would say overall, in aggregate, I don't think we see the same level of just inflation across the board in the extreme upside tail in commodities as we do in the S&P. Don or Mark, where do you guys weigh in on this?
Well, it does exist, but it exists in different ways. You know, you've got to understand the tail risk is going to exist in where the commodity or whatever can crash in that direction. So, you know, oil has very much a smile, but if there is a tail risk to it, it's in calls. Because, you know, people are really, there's a lot of people afraid of oil crashing up, which is what it will do. You'll see that same kind of tail risk in, you know, the 10-year note or the 30-year, where people think that the prices can crash higher, not lower. Now, that remains to be seen whether that's true. So, you know, but do you see people actively buying that tail risk? Well, no, not in the same way. Why? Well, one, with stocks, you have what's called overnight risk that almost doesn't exist in commodities. In commodities, you do have overnight liquidity risk and some weird things like that. But, you know, there's the ability to trade things like oil and the S&Ps almost 24/7 now. You know, FX, kind of the same thing. Really, equities are where that overnight risk is. And I think a lot of what creates tail risk is, in fact, overnight risk. Maybe that is does that kind of explain that?
That's an interesting perspective, actually. The ability to sleep at night is certainly something people will pay for, and you have that certainly to a lesser degree in the equities than you do in the commodities, where you could get out 24/7 for the most part. That's an interesting perspective. Right. The sleep at night premium built into the tail risk. I like that.
Yeah, well, overnight risk, and then the other thing is, you just have to be aware of where it's located and who the customer is. You know, the other thing to remember about commodities is you get a lot of speculators that are trading here and there and that know what they're doing, right? The people actually buying and selling commodities are using them in mass, are using them as an actual hedge against usually a physical that they hold. So, you know, the products are used very differently too.
Yeah, that's what I was getting to. The user base is much different on the futures and futures options side. That's why we tend to see very different use cases across the board for a large number of futures and futures options products. People actually buy weekly options substantially versus they predominantly sell them in the equity options side and things like that. That just, you know, because of that mostly professional, mostly end user base out there, it tends to result in a very different, much more specialized, much more specific, and much more sometimes knowledgeable paper flow, because that's their product. That's what they trade in and day out. That's what they use for their business. They're very well versed in the vagaries of those products. So the answer to your question there, Mr. Who was that? Theodore, is yes, it exists, but certainly not across the board to the same extent as we see in the major equity indices for many of the reasons we just laid out. So there we go, our first mailbag of the year. It was a good one. It was a fun one. If you too would like to join your fellow listeners and be heard on the mailbag, then there's a number of different ways you can do it. You can just leave us a comment at theoptionsinsider.com. Of course, you can always shoot us an email, questions@theoptionsinsider.com. Just put the title of the show you're referring to in the subject line so we know where to send your question, or you can hit us up on Twitter or Facebook. We're very easy to find there as well. So a lot of different ways to reach out to us and join us on the old mailbag. And now we're going to close out the mailbag for this first episode of 2013 and dive right into our crystal ball segment.
And now we take a look at the crystal ball.
All right, and that melancholy music means it's time for our final segment, indeed the crystal ball segment. This is where, of course, we peer into the future to attempt to divine what the Vol gods hold in store for us for the coming week. And if you've listened to the show at all over the past few months, then you know we've been harping upon this fiscal cliff, and that once it came, regardless of the outcome, unless it was extremely unpredicted, we were going to see exactly what we saw, an aggressive implosion from an implied vol perspective. That, of course, is what we saw unfolding over the past week or so. And so if you listen to the show and our crystal ball segments over the past few months, you probably were fairly well positioned ahead of that movement. So kudos to us, and hopefully, listeners, you paid attention and you survived this tumultuous movement unscathed. And now, of course, comes the interesting part where we look ahead to the future. We've already had the big move. We're still fluttering a little bit from it as we record. The major indices are up about 0.3% on the day, a little bit quieter than the movements we've had over the past couple of sessions, but still a little bit to the upside. Market obviously still feeling joyous, celebratory post-cliff deal. Be interesting to see how long this mood holds. Of course, we have earnings season kicking in next week, so that's when really the rubber tends to meet the road. If we start having some dismal earnings, I think a lot of this cliff talk may be erased. Of course, we also have to renew the cliff in a couple of months with renewed negotiations, so nothing is certainly a done deal yet. But it certainly makes our job here predicting the future a wee bit more difficult. Mark, are you going to hang your hat on the earnings and say what we see for earnings will be the predictor for going forward? Or do you think we're just going to be kind of sitting here in these low vol doldrums for the next few weeks?
I think we're sitting here in low vol doldrums for the next 3 weeks. That's why, adjusted for the weekend, the VIX is 14.5 or so. I mean, I think that earnings aren't going to matter very much, and that you're looking at potential for just a slow period of time and a return to realized volatility, probably back into the single digits or the tens, if you will.
So looking at the summer doldrums of midwinter then.
Yes, in the deep midwinter, if you will.
The deep midwinter doldrums. We only have a few periods of activity throughout the year, listeners, and this is usually not one of them. Don, I have a feeling you concur with that sentiment.
I do, and I was trying to think of how you might be able to play this, but I've been talking a lot about the spreads or the relative values of implied and historical or realized as perhaps a way to do this without having to predict the individual direction or the movement of one or the other. And as often happens when you get these corrections or the reversions to the mean, they often overshoot a little bit. They get their momentum going and they keep right going and they blow through what the normal is, and then of course you snap back. And that's what happened here when we looked at that 11 and 12 point spread between implieds and realized and said how crazy it was. Well, historically, that spread's about 3 or 4 points for implied over realized. Here we are talking today about no spread at all or a negative value. And so, it doesn't take somebody being too brave to say that won't persist for too long either, and that some sort of a directional movement towards the normal spread of 3-4 points would be the way to go. The part that's hard is to say how that's going to happen. Will realized stay the same and implied go up? Will implied stay the same and realized go down? Will they both go in their separate directions and widen the spread? Well, the nice thing about that is you don't have to know the answer to that in order to profit from putting on that kind of a spread. And no matter what happens, as long as it widens for whatever reason, you wind up being profitable. But, if I had to guess how it would play out, given that I would predict that it is going to widen that way, I think I probably would go with Mark and say that implieds might actually hang around here, or if they increase only moderately, a point or two, but that realized might retreat once again after having an awful lot of movement this past week or so and a very big jump from the last 2 weeks. Time to probably settle down a little bit and probably see a retreat in historical or realized volatility.
Yeah, Don, where do you think a 30-day QQQ future would be trading, or a 30-day QQQ realized volatility future would be trading right now, with the 30-day implied according to live vol at around 1440?
This is on NASDAQ, right?
Right.
Well, that's rather surprising to me because, you've got the actual volatility that's already been realized at 18, and I'm looking at some predictions from our friends over at the Volatility Institute, which is Professor Robert Engel and the V Lab or Volatility Lab over at NYU, and he's got a Garch forecast for 1 month NASDAQ volatility over 20 at 22. So interesting to see this inversion here, where you're telling me that the futures are as low as 14, where both historical is in the 18 handle and the prediction is even higher than that. So that comes as a bit of a surprise to me.
There you go.
I have a rare buy-em coming from Don. I'm assuming, Don, you can buy a future, right?
Well, you notice I didn't say, I didn't quite say buy it, but I did say it came as a surprise to me.
What you said is that would be an option that should not be sold.
And I didn't say sell it, right? So I'll allow you to make whatever inferences you like, but I'd have to say I'd be leaning in that direction.
I'd have to say
deep down in the dark places that Don doesn't like to talk about is a little primo hog that just says buy him, buy him, buy him, buy him, buy him.
I'm assuming you
can to shut it down.
As Mark said, he gave me a little out there and saying, you can buy futures, can't you? So we don't quite have the same concept of time decay there, and perhaps a little bit more inclined to say yes to that question rather than a similar one with options or long straddles.
I assume you have to have a few long underlyings floating around somewhere, sometime in your trading career, for no other reason than just to hedge. Can't all just be all short premium all the time.
That's right.
All right. So there you have it, listeners. That's our glimpse ahead to what we're thinking is going to be a bit of a repeat of the summer doldrums, only here right in midwinter. So look forward to that. A whole heck of a lot of nothing. Would be indeed an interesting time for a realized vol product over the past week or two, Don, just to see how that would have performed. And hopefully we'll get some insight on that momentarily from you. But certainly we're priming the pump for a lot of interest here in the land of realized vol. But unfortunately, that is going to do it for the Crystal Ball segment and also for this inaugural episode of Volatility Views here for 2013. And before we go, I'd like to check in with my cohorts here on the old Volatility Views panel to see what they have cooking in their respective necks of the woods. And Don, why don't we start with you, because like we said, there is so much grist for the mill right now from a realized vol perspective. Give us a hint, a tease on what listeners can expect for the coming year from Volex and Volex.us.
Well, certainly what our hope is that they can expect to see our products launched on realized volatility, real vol futures, and shortly thereafter options and even ETPs on the major indices. And although there's always a break the last couple of weeks in December as people go on vacation and it's hard to get together for any kinds of negotiations, we've had some encouraging news at the start of the month that things have gone well and that we are even closer to announcing some great news. In the meantime, what's new is a section of our website that we're calling What's New. I actually spoke to our webmaster just a few hours.
How'd you come up with that name?
Well, it's funny. At the end of every show, I said, Mark always asks what's going on, what's new at the Volatility Exchange, what's new on the website. And I kind of have to scramble and go over my notes for the past week or so and see what innovations or new features have been added. I said what we really need right at the top of the home page is a section that's called What's New, where we enumerate exactly what has been added to the site in the past week or so, and with, of course, hypertext and a link that'll get you right to it. And so I'm happy to say that that's been implemented just today. And obviously, we're recording on Friday, usually airing on Monday afternoon. So listeners, just go to the volex.us site, go to the home page. You'll see right at the top what's new, and take a look at some of the features and items that have been added in the past week or two.
Yep, I'm looking at it right now. It's right there in the top left of the page. Listener, you can't miss it. Has all the links to the most recent episodes of this show, a lot of other developments over there at volex.us, including the name change from vol contracts to real vol futures. I like that. A little snappier ring to it, I think, Don.
Well, we're hoping actually that this concept of real vol, R-E-A-L, and then capital V-O-L, all kind of put together, real vol, will actually be our answer, if you will, to VIX and the VIX index. And when people talk about implied volatility, they know that VIX is synonymous with that. And when people talk about realized or real or actual volatility, that they'll start talking about real vol and obviously make the distinction between the two.
There you go. That'll be the next follow-up to dispersion trading. It'll be the real fake vol trade. You put on the real fake today? Oh yeah, I got it on 1x3. But yes, so interesting things coming up in the land of Volex. And before we go, Mr. Sebastian, what is coming up in the land of the pit that may intrigue our Vol Views listeners?
I've got a webinar coming up on the 16th in conjunction with Live Vol Securities. It's going to be on I forget exactly what it's going to be on, but it's going to be on something really good. And aside from that, just Happy New Year and life is good.
So check out optionpit.com/events for Mark's really good webinar. And then sign up for that. Sign up for that one to get some really, really good stuff coming your way very soon. Thank you for that, Mark. And of course, before we go, we also like to thank you, the listener out there, for downloading and streaming and subscribing to this program. Remember, if you'd like to join your fellow listeners and contribute to the show, surf on over to theoptionsinsider.com. You can leave us a comment there. You can, of course, also find all of the archived episodes of this program. You can also find them in iTunes and in Stitcher and just about anywhere else you can find your favorite online audio programs. Of course, you can also reach out to us via Twitter, via email, questions@theoptionsinsider.com, or via Facebook or pretty much any other leading social network you want to use. If you use it, you can probably find a way to reach out to us via it. But that's going to do it for this inaugural episode of 2013, and we'll see you back here next week for another great episode of Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.